Hello, hi guys. This is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's class, we'll be revising audit of NBFCs. Basically, this chapter it is a very small chapter with a weightage of around 5 marks. Without any waste of time, let us revise this chapter NBFC. First of all, we'll understand this term non-banking financial company. Now, if you see this term, it says that NBFC is first of all a company which is involved in financial activities, and just because of the fact that it is involved in financial activities, you should not consider it as a bank. It is a non-banking financial company. Okay, see, it is a financial institution being a company, and a non-banking institution with principal business of accepting deposits. Most of the NBFCs, the principal activity of the NBFCs will be to accept deposits. However, they cannot accept demand deposits. Only bank can accept demand deposits. That is one of the difference between NBFC and bank. However, there are some differences between bank and a NBFC. We will be discussing those differences. And also such other non-banking institutions which are notified by central government as NBFC will also be considered as NBFC. Okay, this is the definition of NBFC. Now, in order to call a company as a NBFC, it needs to fulfill the principal business criteria. What is this principal business criteria? Of the total assets of the company, more than 50% of the assets should be in the form of a financial assets to call a particular company as a NBFC. Now, what is financial asset? Let me give you some example of financial assets. If you have invested in any shares, debentures of other company, then that becomes a financial asset. If you have given loan to any other person or any other entity, even that becomes a financial asset. That means financial asset is an asset wherein you will be having some amount due to be received, and you are generating certain income from such financial asset. That is understanding of financial asset. So of the total assets, 50% or more than 50% should be financial assets, and of the total income that the company generates, more than 50% should be generated through these financial assets. Okay, what will be the type of income that you will generate from financial assets? Mostly you will be generating interest income or dividend income or capital appreciation on these financial assets. Okay, these both conditions, and if you see, and is specified here, so both of these conditions must be satisfied once you become a non-banking financial company. And if these two conditions are satisfied, you must obtain a certificate of registration from RBI. Without obtaining certificate of registration from RBI, you cannot conduct the business of NBFC. And also you should maintain a minimum net own fund of 2 crore rupees once you obtain a certificate of registration from RBI. Okay, all these are the criteria that has to be satisfied in order to carry out the business of NBFC. Okay, you can remember 4 criteria. First one, of the total assets, more than 50% should be financial assets, and of the total income, more than 50% should come from these financial assets. You should obtain certificate of registration from RBI, and you should maintain net own funds of 2 crore rupees. Okay, obtain certificate of registration from RBI and maintain net own funds of 2 crore rupees. Next, types of NBFCs. These types of NBFCs, you can categorize the NBFCs in 3 categories, or based on 3 criteria you can categorize the NBFCs. What are those 3 criteria? First one, based on deposits. Based on deposits, you can categorize the NBFC into NBFC accepting deposit, NBFC not accepting deposits. Okay, firstly, in NBFC accepting deposit, there is no further criteria, just NBFC accepting deposits. In NBFC not accepting deposits, there is further 2 criteria. One is systematically important non-deposit accepting NBFC, non-systematically important, non-deposit accepting NBFC. What is this systematically important, non-systematically important? If total asset size of the NBFC is more than or equal to 500 crores, then that particular NBFC becomes systematically important. If the asset size is less than 500 crore, then that particular NBFC becomes non-systematically important. This is systematically important and non-systematically important categorization is only for non-deposit accepting NBFCs. For deposit accepting NBFCs, there is no further such categorization. Hope that is clear. So that is the first criteria based on which you can categorize the NBFCs. Next criteria, based on the business activity that the NBFC is doing, you can categorize the NBFCs into investment credit company. These type of NBFCs, they will be doing two types of activities. One is they will be investing into shares, debentures, preference shares, bonds, okay, various assets of the other companies, and also they will be granting loans, credits, okay. Loans will also be granted by these types of NBFCs. Those are investment credit companies. Next, infrastructure finance companies. As the name suggests, they will give finance for constructing infrastructure like roads, dams, buildings, bridges, okay. For such infrastructure, they will give loans. Next, core investment company, systematically important. Core investment company, in order to call a particular company as a core investment company, there is certain criteria that needs to be satisfied. Basically, this core investment company, it will be investing only in its group companies, okay. In the equity shares, debentures, bonds of the group companies, this core investment company will invest, and this will not conduct any trading activity of the shares except in block deal, okay. That criteria that has to be satisfied in order to call a company as a core investment company, will be discussing it. Next, infrastructure debt fund. Again, this type of NBFC, it will also be providing finance for the infrastructure projects, but in the form of debt. And microfinance institution, it will be giving loans of small ticket size. And NBFC factors, basically this NBFC factors, what they will do is they will purchase debtors from various companies, and they will also purchase NPAs of the companies, and they will realize these NPAs or the debtors, okay. This is the business that will be done by NBFC factors. And non-operative financial holding company, this non-operative financial holding company is also somewhat similar to core investment company, but the difference is this non-operative financial holding company is there na, it will be holding financial businesses like banks, okay. Non-operative financial holding company will be mostly holding financial companies. So these are the categorization of NBFCs based on the business activity that they do. Next, third type of categorization. This third chart, it is not there in the printed chart that I have provided you. You please note down this scale based regulation in your chart, okay. Now, what is this categorization of NBFC with respect to scale based regulation? Basically, RBI, it wanted to regulate NBFC in a more sophisticated manner, okay. In order to regulate NBFCs, it has divided NBFCs into various types in the form of base layer, middle layer, upper layer, and top layer. Now, for NBFCs which are present in base layer, the regulation from the RBI will be very much minimal, okay. RBI will not control much the NBFCs that are present in base layer, whereas NBFCs that are present in middle layer, RBI will control the NBFCs of middle layer somewhat more when compared to base layer, and the control of RBI will increase on upper layer NBFCs and even on top layer NBFCs, okay. So this categorization of NBFCs here is to enable RBI for proper regulation of NBFCs. RBI can also issue different circulars, different directions for the NBFCs that are present in each of these layers. Okay, for base layer NBFCs, the rules will not be much stringent, whereas for top layer, upper layer NBFCs, the rules will be more stringent. Now, which type of NBFCs will be coming under base layer NBFCs? All the NBFCs which are not accepting deposits and whose asset size is less than 1000 crore, such type of NBFCs will be in base layer NBFC. Next, NBFC peer-to-peer lending. Now you can find various peer-to-peer lending platform, okay, wherein you can take loan from other person and you can also give loan to other person through those platforms. So the companies, the NBFCs which are maintaining these type of platforms are known as NBFC peer-to-peer lending. Now these peer-to-peer lending NBFCs, they will be always in base layer, and also NBFC account aggregators. You can find various apps wherein you can link all your bank accounts, all your financial related information you can input into the application, and it will present your financial information in a more readable format to you. Okay, it will give you what is your net worth, what is your liabilities, all the idea related to your financial health it will give. So the NBFCs which are maintaining those type of uh, which are providing those type of services are known as account aggregators. Even this account aggregator NBFC will also be in base layer. Next, NBFC, non-operative financial holding company, which I have already discussed here. Non-operative financial holding company. This non-operative financial holding company NBFC will also be always in base layer. Next, NBFC not availing public funds and has no customer interface. Okay, the NBFCs which doesn't deal with customers, okay, with the end public, the NBFC will not deal. Those types of NBFC will also be categorized under base layer. Okay, so these are the NBFCs which will be categorized in base layer. Next, middle layer. All the NBFCs which are accepting deposits irrespective of their asset size will be in middle layer, and NBFCs which are not accepting deposits and whose asset size is more than 1000 crores will also be in middle layer. Next, NBFC SPD, that is standalone primary dealer. Basically they will be providing services with respect to foreign exchange. Even these standalone primary dealers will also be in middle layer always. Okay, they will always be in middle layer. In the same way, infrastructure debt fund NBFC will also be always in middle layer. And core investment company, it will be investing in its group companies. And housing finance company, infrastructure finance company, these three NBFCs, that is core investment company, housing finance company, and infrastructure finance company. These three companies, they can be either in middle layer or in upper layer. Who will decide this? RBI, based on the uh, opinion of the RBI. Okay, if RBI wanted to regulate more any of these NBFC, it can shift the NBFC into upper layer, or it feels that that much regulation is not required, it can just keep it in middle layer. So based on the discretion of RBI, these three NBFCs, CIC, housing finance company, and infrastructure finance company, they can be either in middle layer or in upper layer. Next, moving to upper layer. Now, in the upper layer, RBI will specifically place some NBFCs which RBI feels that these NBFCs needs to be regulated more. If RBI feels that any of the NBFC needs more regulation by RBI, then it will put that NBFC into upper layer. Okay. Next, top layer. Most of the times, this top layer will be empty until and unless RBI feels that the risk of any NBFC has increased dramatically. In that case, RBI will keep those NBFCs whose potential risk has increased dramatically in top layer. So what is the difference between upper layer and top layer? Both upper layer and top layer, the NBFCs will be put in these layers based on discretion of RBI. But in the upper layer, RBI will put the NBFC if it feels that more regulation is required on a particular NBFC. Whereas in case of top layer, if the risk of any NBFC has increased dramatically, then RBI will put such NBFC into top layer. Okay. So this is categorization of NBFC with respect to scale based regulation. Next, there are certain NBFCs that are exempted from registration. I have already told you, every NBFC it needs to obtain certificate of registration from RBI, but there are certain NBFCs which need not obtain certificate of registration from RBI. Why? Because those NBFCs, they are regulated by some other regulators. Since other regulators are already regulating them, why again RBI has to regulate these NBFCs? So such type of NBFCs are exempted from obtaining registration. What are they? Housing finance institution, National Housing Board will regulate those housing financial institutions, so they need not obtain certificate of registration from RBI. In the same way, merchant banking companies will be regulated by SEBI, stock exchanges will be regulated by SEBI, stock broking companies will be regulated by SEBI, venture capital funds will be regulated by SEBI, Nidhi companies will be regulated by MCA. If you see, there is a separate chapter in Companies Act with respect to Nidhi companies. So MCA will regulate Nidhi companies. So Nidhi companies, even though they are doing financial business, they need not obtain certificate of registration from RBI. In the same way, insurance companies are regulated by IRDA. Chit fund companies regulated by Chit Fund Act. Microfinance companies, they will be regulated by again NBFC. And securitization and reconstruction companies, mortgage guarantee companies, non-systematically important CIC, okay, core investment companies, and alternate investment fund. All these NBFCs, they are regulated by other regulators. So RBI, it need not regulate these NBFCs, so they need not obtain certificate of registration from RBI. Hope that is clear. As I have already told you, there are some differences between NBFC and bank. What are those differences between NBFC and bank? First of all, NBFCs, they cannot obtain demand deposits. The demand deposit means saving account. Okay, they cannot open a saving account of the public, and they cannot accept the demand deposits in saving account. NBFCs can accept only time deposits. Hope that is clear. Time deposit means fixed deposits. Next, NBFCs do not form part of payment and settlement system. That means in case of bank, let's say HDFC Bank, in HDFC Bank you opened account, then you can issue check in the NBFC bank name. Okay, HDFC Bank check you can issue. If you have opened an HDFC Bank account, you can add it to UPI, but such facility will not be available to NBFCs. Okay, they are, because they are not part of payment and settlement system. Okay, even debit card, credit card, that those type of instruments can also not be issued by NBFCs. And DICGC, okay, Deposit Insurance and Credit Guarantee Corporation, insurance is not available for deposits that are made with NBFC. Basically, for the deposits that you make with banks, there is DICGC insurance that is applicable for these deposits. But however, if you make any such deposits with NBFC, then such insurance is not available. Next, no minimum exposure to priority sector. Basically, for banks, this priority sector lending concept is applicable. The government, it will select some priority sectors, like for example agriculture, and it will mandate the banks to issue at least 5% of all its funds to such agriculture loans. So there should be priority sector lending is applicable for banks, but for NBFCs, such priority sector lending criteria is not applicable. They can issue loans to whomever they want. Hope that is clear. Next, prudential norms. RBI, it has issued certain prudential norms to NBFCs. These prudential norms, they are related to capital requirement, that is the minimum capital. Okay, tier 1 capital, tier 2 capital, that has to be maintained by NBFC. And income recognition, with respect to income recognition, certain prudential norms. And finally, with respect to provisioning requirements, there are prudential norms that are issued by RBI. We will see each of that. First of all, capital requirement. Every NBFC, it needs to maintain tier 1 capital and tier 2 capital. the tier 1 and tier 2 capital both together should be not less than 15% of aggregate risk weighted assets. What is this aggregate risk weighted assets? Basically, RBI for each class of asset, it has given a risk percentage. Okay, risk weight it has given. You need to multiply the asset with the respective risk weight and arrive at a risk weighted asset value. Now, of these total, okay, if you see, for certain types of assets like current assets, fixed assets, the risk weighted the risk weight is 100%. For bonds of public sector, risk weight is 20. Okay, like this, for each type of asset there will be risk weight. So you need to calculate aggregate risk weighted assets of the NBFC, and of that aggregate risk weighted asset, minimum 15% must be tier 1 and tier 2 capital. Next, tier 1 capital should be minimum 10% of the total risk weight assets. However, for NBFCs which are granting loans against jewelry, okay, against gold jewelry, these NBFCs, they need to maintain minimum tier 1 capital of 12%, not 10%. Okay, for all other types of NBFCs except microfinance institution and infrastructure debt fund, the minimum tier 1 capital is 10%, but for NBFCs which are providing loans against gold jewelry, the minimum tier 1 capital is 12%. However, for these NBFCs also, tier 1 plus tier 2 both together is 15%. Hope that is clear. Okay, here there is two criteria. First of all, tier 1 and tier 2 capital both together it should be 15%, and only tier 1 capital it should be 10% for all NBFCs. For NBFCs which are providing gold loans, for them tier 1 capital should be 12%. Hope that is clear. And these are risk weighted assets. Next, income recognition. Now, on NPS, you should recognize income only on actual realization basis. Only when the income is realized, you should recognize it. In case of in case of NPS, non-performing assets. And if you have already recognized any income on NPS and it has not yet been received by you, then you have to reverse such income which has not yet been received by you. This is with respect to income recognition. Next, asset classification. NBFCs, they have to classify their assets. Basically, assets here, this asset classification, it includes the loans that have been given by NBFCs. There are four classifications. One is standard asset, substandard asset, doubtful asset, loss asset. When will you categorize an asset as a standard asset? The default category of any loan will be standard. Okay, if there is no default in the repayment of the loan, then that will be by default it will be in standard asset classification. And substandard asset, for substandard asset classification there is two bifurcation. In case of non-systematically important non-deposit taking NBFCs, the NPA for not exceeding 18 months. Okay, if the loan account is in the state of NPA for a period not exceeding 18 months, then the categorization of such NPA will be substandard asset in case of non-deposit taking non-systematically important NBFC. And in case of systematically important non-deposit taking NBFC and all the deposit taking NBFC, if the loan account is in the state of NPA for a period not exceeding 12 months, then that will be categorized as substandard asset. Hope that is clear. Here for classification of substandard asset, the period is different for non-deposit taking non-systematically important NBFC and deposit taking NBFCs and systematically important non-deposit taking NBFCs. Okay, for the first category it is 18 months and for second one it is 12 months. Next, doubtful asset. In doubtful asset also again it is two categories, the same, non-systematically important non-deposit taking. If the NPA is categorized in the state of substandard asset for a period exceeding 18 months. Okay, if any NPA is in the state of substandard asset category for a period exceeding 18 months, then that will automatically be shifted to doubtful asset category in case of non-systematically important non-deposit taking NBFC. And in case of systematically important non-deposit taking and deposit taking NBFC, if the NPA is in substandard asset category for a period exceeding 12 months, then it will automatically be shifted to doubtful asset. And loss asset means if management thinks that it will not be able to realize this amount from the debtor, then it will be categorized under loss asset. Hope that is clear. Next, when will a loan turn into NPA? If interest or principal is overdue for a period of 3 months or 6 months, then that particular loan will become NPA. When it will be 3 months and when it will be 6 months. See, for all the NBFCs, it is 3 months generally. But for non-deposit accepting, non-systematically important NBFCs, it is 6 months. So, for NBFC deposit taking and also NBFC non-deposit taking systematically important, it is 6 months, it is 3 months, whereas for NBFC non-systematically important non-deposit taking, it is 6 months. Hope that is clear. Since it is not systematically important, the time period is more, and here it is systematically important, time period is less. And for deposit taking, since public money is involved, the time period is again less, 3 months. Hope that is clear. And in case of lease rental or hire purchase installments, if the lease rental amount or hire purchase amount is overdue for a period of 12 months or more, then that particular account becomes NPA. Hope that is clear. Just a second. Yeah. Next, provisioning requirements. Basically, why we have classified all the assets into standard, substandard, doubtful, loss. The purpose is to provide provision, okay, to make proper provision. Now for all the assets which are in the category of standard asset, the provisioning requirement, in case the NBFC is systematically important non-deposit taking, and also for all deposit taking NBFCs, it is 0.4%, okay, 0.4% provision must be provided for all the loan accounts that are in standard asset category in case of all deposit taking NBFCs and also non-deposit taking NBFCs which are systematically important. Hope that is clear. And for non-deposit taking, non-systematically important, the provisioning requirement is 0.25%. Next, for assets which are in substandard category, the provisioning requirement is 10%. And for assets which are in doubtful category, if the asset is in doubtful category and there is no security, that is the loan is unsecured, then 100% provision has to be made. If the asset is in doubtful category and it is secured, and the period for which it has been in doubtful category is up to 1 year, then 20% provision. If the period for which it is in doubtful category is from 1 year to 3 years, then 30% provision. If it is more than 3 years, then 50% provision. For assets which are in loss category, you need to completely write it off for 100% provision. That is a provisioning requirement. Next, audit procedures regarding prudential norms. The prudential norms which we have discussed till now, with respect to that, what are the audit procedure auditor need to perform? First of all, he need to check whether all the prudential norms have been properly followed or not. And for the purpose of granting demand and call loans, whether there is a proper policy that has been approved by board of directors or not, you need to check that. Okay, for the purpose of granting demand and call loans, there should be a board approved policy. You need to check that board approved policy. Next, whether income on NPA has been recognized only on realization basis. This is one of the important point that need to be checked in case of NPA. Okay, in case of NPA, you should not recognize income until and unless income has actually been received. Next, whether accounts that have been categorized as NPA during the previous year have been removed from that category during the current year, or are they being continued in the same category of NPA in the current year also. You need to check that. If in case it has been removed from the category of NPA during the current year, you need to check whether it has been properly regularized or not. See, if not, check whether they have been properly regularized, whether the payment has actually been received. You need to check that, and check whether any loans granted against own shares of the NBFC. Okay, you cannot grant loan against the security of own shares of NBFC. That means generally for purpose of granting loan, you will ask for some security, right? Now now here NBFC is giving loan to, let's say, Mr. A. Now Mr. A is also having some shares in NBFC. Okay, some 10% shareholding of NBFC is held by Mr. A. Now Mr. A is asking NBFC to give loan to Mr. A, accepting these shares as security. Since these shares belongs to NBFC itself, NBFC cannot grant loan against the security of its own shares. Next, RBI directions. RBI has issued directions with respect to prudential norms. The prudential norms which we have discussed till now, classification of assets, provisioning requirement, income recognition, all that prudential norms have been issued by RBI. This part is completed. Next, deposits. With respect to deposits, RBI has given NBFC acceptance of public deposit directions, which is applicable for all the NBFCs which are accepting public deposits. So this direction with respect to deposits is given to NBFC. Okay, RBI has given directions to all the NBFCs with respect to acceptance of deposits. Now auditor has to check whether the NBFC has followed this acceptance of public deposit directions 2016 that have been issued by the RBI or not. Hope that is clear. Next, RBI has also issued directions directly to auditor of NBFC. Okay, audit report directions. Mostly students will be confused with respect to this directions. You need to first of all remember that the directions that have been issued by RBI, first it has issued directions to NBFCs with respect to acceptance of public deposits. Next, it has issued directions to auditors who are conducting audit of NBFCs. Hope that is clear. Now this audit report directions, they are again further categorized into three. Firstly, directions which are applicable to auditors of all the NBFCs, whether that NBFC is accepting deposit or not accepting deposit, auditor has to report these 3 points. Okay, under this all NBFCs criteria, there are certain 3 points that has to be reported by the auditor. You need to report on those 3 points. Next, NBFCs accepting deposits. For the auditors who are conducting audit of NBFCs which are accepting deposits, RBI has given certain directions, certain reporting directions. So on those points, auditor needs to report in his audit report. Hope that is clear. Now this auditor who is auditing an NBFC which is accepting deposits, he needs to report on the points that are present here, and also he needs to report on points that are present here also. Why? Because these directions are applicable to all NBFCs. All NBFCs means NBFC accepting deposits will also be covered under that. Hope that is clear. Next, directions to NBFCs which are not accepting deposits. Under this, there are certain points on which the auditor need to report. Again, he needs to report on these points along with these points, because these are applicable to all NBFCs. Hope that is clear. And finally, there are certain exception reporting that we'll see. Mostly, if we'll complete this deposit directions and audit report directions, our chapter gets completed. Now, generally, the basic audit procedures that the auditor will follow in case of audit of NBFC. First of all, he will obtain understanding of the business of NBFC by reading MOA, AOA and board meeting minutes, and he will also obtain understanding of internal control system that is being followed in the NBFC, and he will check whether net one funds of 2 crore is maintained or not, whether NBFC has obtained certificate of registration from RBI or not, and whether NBFC is allowed to continue to hold that certificate of registration from RBI or not, and whether NBFC holds public deposits invested certain specific percent specified by RBI in the liquid assets. Basically, NBFCs, they need to maintain certain percentage of total deposits in some liquid assets with some commercial banks. Whether such a criteria is met or not, you need to check, and whether quarterly return with RBI has been properly filed or not. These are some audit procedures that the auditor need to perform with respect to most of the NBFCs. Now, coming to our discussion with respect to RBI directions, NBFC's acceptance of public deposit directions, Reserve Bank India directions 2016. Now, these directions are issued by RBI to NBFC. These directions has to be followed by NBFC. Auditor has to check whether these directions have been followed by NBFC or not. Now, for checking that, what points auditor will verify? First of all, check appropriate classification of NBFC, whether NBFC has been properly classified. There are various classifications of NBFC. NBFC deposit taking, NBFC non-deposit taking, core investment company, infrastructure finance company, housing finance company. Like this, there is various classifications of NBFC. You need to check whether the NBFC has been properly classified or not, because based on classification of NBFC, the directions that has to be followed by NBFC, the rules that has to be followed by NBFC, they will change. Okay. Next, ceiling on quantum of public deposit is linked to credit rating. See, the amount of public deposit that the NBFC can accept depends on the credit rating that has been allotted to it by the credit rating agency. Generally, every NBFC, it needs to obtain a credit rating from the credit rating agency. There are various credit rating agencies like CIBIL, Fitch, and even S&P Global, like this, JP Morgan. There are various organizations which will allot credit ratings. Now, based on that credit rating, okay, let's say if the credit rating of NBFC is AA, then the maximum amount of public deposit that it can accept can be, let's say, some 1,000 crores. If the credit rating drops to AA negative, then the amount of deposits that it can accept might be some 500 crore. I'm just giving an example. So based on credit rating, the amount of deposit will depend. So whenever credit rating drops, the auditor needs to check whether the respective deposit accepting capacity has been regularized or not. Okay. Next, test check the interest calculations on the deposits that you have accepted. You'll have to pay interest, right? Whether that interest has been properly calculated as per the agreed rate of interest or not. Acceptance or renewal of deposits by NBFC only after written consent or written application from the depositor. You cannot accept deposit from the depositor, or you cannot renew the existing deposit of the deposit holder without a written consent from the deposit holder. And verify deposit register with supporting receipts. Okay, you need to verify the deposit register. Check whether liquid investments are in safe custody of commercial bank. I have told you, a certain percentage of the total deposits has to be kept in the form of liquid investment with the commercial bank, either in the fixed deposit of the commercial bank or any other bonds of the commercial bank. You need to keep the certain percent of the total deposits that you have accepted with the commercial bank. And check whether returns are filed in a timely manner. You need to file certain returns with the RBI, whether they are filed in a timely manner, and board resolution passed for not accepting or not holding public deposits. So these points you need to verify with respect to these NBFC accepting deposit directions. Next, just a second. With respect to investment credit company, what audit procedures you need to perform? First of all, since it is a investment company, it would have made various investments in shares, debentures, and preference shares, bonds. You need to physically verify the share certificates and the investment certificates of those NBFC. If they are in dematerialized format, you need to obtain confirmation from the respective depository, and no loan against its own shares. This point we have already discussed. Since it is an investment credit company means it will also grant loan. So while granting loan, it should not grant loan against the security of its own shares. And dividend declared and received by the NBFC and the interest that has been accrued to NBFC has to be properly accounted in the books of accounts. See, with respect to dividend, it needs to be accounted in the books of accounts only when the NBFC has received that dividend. Okay, whereas interest has to be accounted in the books of accounts on accrual basis. So account for dividend only on cash basis, whereas interest has to be accounted on accrual basis. Verify board meeting minutes for purchase or sale of investment. Okay, in order to invest, in order to purchase any new investments exceeding certain criteria, you might be requiring the approval of board of directors. For that, the board resolution has to be checked whether board of directors has approved for investing in that particular security. Next, check compliance with AS 13. Okay, with respect to investments, you need to check compliance with respect to accounting standard, and check classification of loans and advances has been properly made. Okay, for the purpose of provisioning, you need to classify them now. Okay, asset classification, standard, substandard, doubtful loss, whether such classification has been made properly or not, and verify investment made in subsidiary or group companies. So these points you need to verify with respect to investment credit company. Next, auditors report direction. Now these directions, they are issued by the RBI to auditors of NBFCs. Now with respect to auditors who are auditing NBFCs, okay, for all NBFCs, whether it might be accepting deposits or not accepting deposits, auditor needs to report whether certificate of registration has been obtained by NBFC. If it has obtained, whether entitled to hold certificate of registration as per principal business criteria. That 50% principal business criteria is there now, whether that principal business criteria is being satisfied by NBFC, and whether NBFC is uh, you know uh, whether the NBFC is permitted to continue to hold such a certificate of registration or not. You need to report on this point. And finally, whether net own fund of 2 crore is being maintained by NBFC or not. These 3 points you need to report in your audit report for all the NBFCs. Next, NBFCs accepting public deposits. In case of NBFCs accepting public deposits, you need to report on following 6 points along with these 3 points. Okay, these 3 points, they need to be reported for all NBFCs. So what are the additional 6 points that need to be reported for NBFCs that are accepting public deposits? Whether public deposits are well within the limit. I have told you now, based on the credit rating that has been allotted to NBFC, the public deposit limit will be fixed. So whether the public deposits that have been accepted by NBFC are within that limit or not, you need to check. If the public deposit has exceeded that limit, you need to regularize them. Regularize means bringing the deposit amount below that limit. Okay, under regularization, you cannot accept any new deposits, and the existing deposits will run to maturity, and you should not renew any of the existing deposits without obtaining consent of the particular deposit holder. Okay, these 3 points will be covered under regularization. Whether accepting public deposit without minimum credit rating. What is this minimum credit rating? There will be certain minimum credit rating that the NBFC should have in order to accept public deposit itself. Okay, not in for deciding how much public deposit the NBFC can accept, but also to decide whether this NBFC can be allowed to accept public deposits or not. For that also, there should be certain minimum credit rating that the NBFC should achieve. Let's say that minimum credit rating is triple A. Only if triple A credit rating is there, NBFC can accept public deposit. Once this credit rating is there, based on the credit rating, whether it is AA plus AA minus, based on that limit will be fixed. But in order to decide whether NBFC can accept or cannot accept, there will be certain minimum credit rating that must be achieved by NBFC. Whether that minimum credit rating is achieved, without achieving that minimum credit rating, without having that minimum credit rating, whether NBFC is accepting any deposits, you need to report that. So first 3 points they are with respect to deposits only. The first one, whether the public deposits are within the limit. If it has exceeded the limit, whether they have been regularized, and whether NBFC is accepting public deposits without having minimum credit rating. Okay, next, whether capital adequacy ratio correctly determined and complied with minimum CRAR requirement. Okay, there is certain capital adequacy ratio, that 15% we have discussed in tier 1 plus tier 2, it should be 15%, whether that capital adequacy ratio it has been complied or not, whether NBFC has defaulted in payment of any interest or principal. Again, this one also you can consider with respect to deposit only. Okay, on deposit only you will pay interest, right? So whether NBFC has defaulted in payment of any interest or the principal to the deposit holders, you need to report. And return on deposits has to be furnished to the RBI within stipulated period in NBS 1, whether that return has been furnished or not. So here you can say 4 points related to deposits, 1 point related to capital adequacy ratio, 1 point related to return filing NBS 1. Okay, these 6 points you need to report in case of NBFCs accepting public deposits. Next, directions for auditors of NBFCs which are not accepting public deposits. In case of these NBFCs, auditor need to report whether board of directors have passed a board resolution for NBFC not accepting deposits. Okay, board of directors has to pass a resolution stating that our NBFC will not accept any deposits. Even after passing such a resolution, whether NBFC has accepted any public deposits during the year, if yes, you need to report it, and whether all the prudential norms have been properly complied by the NBFC or not. And in respect of NBFCs which are systematically important non-deposit taking, okay, systematically important, in case of systematically important means asset size more than 500 crore, you need to report whether capital adequacy ratio that has been disclosed in the return that has been submitted to the RBI has been properly calculated, and whether it has exceeded the, or it has complied with the minimum CRAR requirement. We have seen that 15% tier 1 plus tier 2 and 10% only tier 1, and in case of NBFCs which are giving gold loans 12%, that minimum CRAR ratio requirement has to be satisfied. And annual statement of capital funds risk assets should be filed with RBI within stipulated time, and whether NBFC has been correctly classified as NBFC microfinance institution. If NBFC is a microfinance institution, whether it has actually been classified as microfinancial institution or not, you need to report this point. Okay, so these 5 points you need to report in case of NBFC not accepting public deposits along with these 3 points. Okay, you should not miss this. Next, exception reporting. Auditor, he needs to give exception reporting. Exception reporting means when NBFC has not complied with any of these 3 aspects, then auditor will give that non-compliance in the exception report. What are these 3 aspects? First one, chapter 3b of RBI Act. Chapter 3b of RBI Act will be containing provisions that has to be followed by NBFCs which are accepting deposits. If these provisions has not been complied, then auditor will give or auditor will qualify the points that have not been complied in this exception report. Next, NBFC acceptance of public deposit reserve bank directions 2016. If any of these provisions have not been complied, then also the exception report will be issued by the auditor. Next, NBFC non-systematically important non-deposit taking reserve bank directions 2016 and NBFC systematically important non-deposit taking and deposit taking reserve bank directions 2016. If any of the provisions of these directions have not been complied by NBFC, then also auditor will issue exception report. This exception report, to whom it has to be furnished? It has to be furnished to concerned regional office of Department of Non-Banking Supervision of RBI. Okay, every region it will be there will be a regional office belonging to Non-Banking Supervision Division of RBI. For that regional office, you need to send this exception report. Okay, in the regional, in the region in which your NBFC is falling, for that regional office you need to send this exception report. Hope that is clear. Next, difference between division 2 and division 3 of schedule 3 of the Companies Act. Basically schedule 3, it will be containing format for financial statements. Division 2 contains Ind AS format for companies other than NBFC. Division 3 contains Ind AS format for NBFCs. What is the difference between these two? Basically NBFCs, they are allowed to present the assets in the form of liquidity. Okay, in the order of liquidity, NBFCs can present their assets in the balance sheet, but that such option is not available for other companies which are other than NBFCs. This option of presenting the assets in the order of liquidity is not available. That is one of the difference between division 2 and division 3. Next, NBFCs need to separately disclose dues from LLPs in which director is partner or member. Okay, let's say there is a particular NBFC. In this NBFC, Mr. A is director. Mr. A is also partner of a particular LLP. Now, if that LLP has taken any loan amount from this NBFC, then this LLP, the name of this LLP has to be clearly shown, okay, separately shown as amount of loan granted to that particular NBFC in the financial statements. You need to disclose the name of that NBFC because the director of NBFC is partner or member of such LLP. Hope that is clear. Next, disclose items of revenue from the operations and other comprehensive income. Here I have just kept it as other income. Make it as other comprehensive income. Generally this other comprehensive income, you'll just present it in the notes, but in case of NBFC, on the face of profit and loss, you need to disclose normal revenue and also income from other and also other comprehensive income on the face of profit and loss statement. Hope that is clear. Generally in case of other companies, you'll just show it in the notes to the financial statements. Next, separate disclosure with respect to trade receivables whose credit risk has increased significantly. Okay, if the credit risk of any of the trade receivable has increased significantly, then you need to separately disclose those trade receivables whose risk has increased significantly. And now there will be certain small expenditures and incomes which you will be showing as part of other income or other expenditure. So which expenditures can be shown as part of other expenditure or which income can be shown as part of other income? Basically in case of NBFC, those expenditures which are exceeding 1% of the total income, they need to be disclosed separately. You cannot club them into other expenditure or other income. Okay, if any of the expenditure or any of the income is exceeding 1% of total income of NBFC, then it needs to be disclosed separately. You cannot club it into other income or other expenditure in case of NBFC. Whereas in case of other than NBFC, it is 1% of total income or 10 lakh rupees, whichever is higher. Okay, if any income or any expenditure is exceeding 1% of total income or 10 lakh, whichever is higher, then you need to disclose it separately. You cannot club it into other income or other expenditure. That is the difference between division 2 and division 3 with respect to other income or other expenditure. And if at all there are any conditions or restrictions that are attached with respect to distribution of statutory reserves, you need to disclose those conditions in the financial statements of NBFC. That requirement is not applicable for other than NBFCs. Next, classification of frauds by NBFC. The frauds that takes place in NBFCs, for the purpose of proper reporting, they have been classified. Okay, in order to report, in order to remember this, you can use the mnemonic: mutual fund by name SIA. There is a mutual fund and the name of that mutual fund, the name of such mutual fund is SIA. Now M stands for misappropriation and criminal breach of trust. F stands for fraudulent encashment through forged instruments, manipulation of books of accounts or other or through fictitious accounts. U stands for unauthorized credit facilities extended for reward or illegal gratification. N stands for negligence and cash shortages. there is nothing for D. C stands for cheating and forgery. I stands for irregularities in foreign exchange transactions. A stands for any other type of fraud not specified above. Okay, through this mnemonic you can remember all these frauds. Now, in case of negligence and cash shortages and irregularities in foreign exchange transactions, you have to report them as fraud only if intention to cheat or defraud is suspected. Okay, if intention to cheat or defraud is not suspected, then you need not report them as fraud in case of cash shortages and also foreign exchange transactions. That is an exception. However, for this exception there is further another exception. However, irrespective of intention, following need to be reported as fraud. Okay, first of all, it has been said that negligence and cash shortages as well as irregularities in foreign exchange transactions, they should not be reported as fraud if the intention to cheat or defraud is not suspected. However, it further says that in the following cases, they need to be reported as fraud even if intention to cheat or defraud is not suspected. What are such cases? First, if cash shortage is more than 10,000. Okay, if the cash shortage is more than 10,000, irrespective of whether intention to cheat or defraud is suspected or proved, you need to report it as fraud. And also another situation, cash shortage exceeding 5,000, but it has been detected by management or auditor or the inspecting officer and it has not been brought to the notice of a management or auditor at the time of its occurrence by the person handling the cash. Okay, in this situation also, even if intention to defraud or cheat is not suspected or proved, you need to report it as fraud. Hope that is clear. By this revision of NBFC audit gets completed, you can download this chart from the link that I will be providing you in the description. And if you wanted to purchase our classes, you can visit our website lecturepedia.in and you can place your order. I'll be winding up this video as of now. Take care. Bye bye. See you.